Joining us right now is John Hilsenrath, the Wall Street Journal's global economics editor. And John, we're going to get the number momentarily. We know that you're often focused on the consumer and what the consumer is showing within this GDP number. The 3.5% is the number, John. 3.5% is better than expected. We were expecting 3.3%, and we're watching markets for any reaction. Your expectations and your reaction to a 3.5% number, John.
Well, that's a strong number. What I want to do is break this down a little bit and see where it comes from. I think trade was probably a drag for the quarter. I think that we also have to look very carefully, in addition to the consumer, at government. There's been as we've reported today in the Wall Street Journal, there's been a big pickup in military spending. Government spending is contributing a lot to growth right now.
Consumer spending is up. Consumer spending is doing well within this, up 4%?
Correct, 4% in the third quarter, the strongest rate of growth in almost 4 years on the consumer side.
Street was looking for up 3.3 on that as well, so that's a big beat.
That's a big beat.
Yep. John.
Right, and that makes sense. You've got an unemployment rate that's down under 4%, lowest level since the 1960s, and you also have tax cuts that are making their way through the system. So we should be seeing strong consumer spending right now. We also have to look at what's going on the business investment side. You know, for this growth to be sustainable in the long run, we need to see more business investment, and I want to see how that breaks down as well.
Investment by companies was weak, John. Non-residential fixed investment, spending on commercial construction equipment, intellectual property products like software rose only 0.8% in the third quarter. That was after rising at an 8.7% rate in the second quarter and 11.5% in the first.
Inflation's also light here. Core PCE came in up 1.6% quarter over quarter. Street was looking for up 1.8%. So there's not some runaway inflation story here. It looks like consumption's strong, as Dagan points out, investment weak.
And just
market's improving.
Right. One more thing. Private inventories, which is something that Liz was talking about. Private inventories added more than 2 percentage points to the third quarter growth rate, reversing that trend that you saw in the second quarter when companies were drawing down their stockpiles ahead of the tariffs.
That has been sort of an offset ongoing quarter to quarter with the widening trade deficit. It seems to me that consumer news here is very important because the fourth quarter is all about holiday sales, all about consumer spending. The fact that that's held up and actually beat by such a wide margin, I think, tees us up for less pessimism, if you want to look at it that way, about the fourth quarter.
And interesting, there's no revisions on the second quarter, John. The second quarter was real strong at 4.2%. That is not being revised downward. So that stays in place with a better than expected initial or advanced reading, the first reading for the third quarter at 3.5%, John.
Well, so I'd say a few things here based on those breakdowns that you give me. One is let's go back and talk about that inflation number. The market has been very concerned, and the president has been very concerned about the Fed continuing to raise interest rates going into next year. You know, the inflation numbers have come in kind of soft over the last couple of months, and I think the Fed's going to have to start paying attention to that and factor into how far they want to go on interest rate increases. On the inventory piece that you talked about, that's a volatile number. It doesn't fundamentally have much to do with economic growth in the long run. So the fact that it added a lot to growth in the third quarter, I think, becomes a potential drag on growth in the second quarter. A lot of the estimates that we get at the Wall Street Journal for fourth quarter is that it's going to slow down a little bit on overall growth, and it's going to slow down. Growth is going to slow down going into 2019. That inventory piece plays into that.
It seems to me it's almost a perfect number for people who are Fed watchers, though, right? Because it isn't really high enough to spur alarm at the Fed, any kind of acceleration or, incremental rate hikes next year. Neither is it low enough to kind of take them off their path. So it seems to me that's sort of a neutral.
Although I will add, looking at this report, higher borrowing costs have hurt housing and auto sales. Spending on motor vehicles and parts added just 0.09 percentage points to third quarter growth. And in terms of residential fixed investment, fell at a 4% annual rate in the third quarter.
Yeah, so residential has been a really big drag for several quarters now. And that's continuing. It's a little puzzling because there's undersupply in the housing market, but builders just aren't building because labor is short and land supply is short and costs are going up. So you know, we should be seeing more building, and we're just not
John,
getting it right now.
There is, during the summer, there was a plentiful amount of inventory coming on the market in many housing markets that were already weak. There are a lot of pockets of weakness in housing in this country that are overlooked because we tend to focus on the metropolitan areas.
You know, and supply actually has been going up in some of these metrics. I think I saw 7.1 months supply in one of the metrics this week on existing home sales. And the other thing I'll point out is even in the Fed minutes, it was pointed out that higher rates might be crimping residential investment, to your point, Sean.
Well, I also think that it's you know, understandable that the third quarter rate of business investment was weak. This is actually the weakest since the fourth quarter of 2016. Spending on structures down 7.9%. You would expect companies to pull back in terms of spending with the uncertainties of tariffs, with the uncertainties of the demand picture on the horizon, because there is all of this worry, this narrative that things slow down a bit. So I'm not surprised that the level of investment spending is weak in this report, John, particularly after we've seen animal spirits these last 2 years. Spending has been up.
Well, so there are three things going on in the business investment side we have to look at. One is, you mentioned structures down. Structures has been very strong because there's been a lot of investment going on in oil and gas rigs as oil prices came up. They've stabilized, so maybe that spur to growth that we've gotten has also stabilized. The other thing you just mentioned, you know, with tariffs coming on, a lot of companies are talking about slowing their investment plans because they're just so uncertain about what the trade landscape is going to look like. And then the third piece is tax cuts. The Trump administration, Republicans in Congress, cut taxes, corporate tax rates very aggressively to try to spur business investment. But it looks like this tariff uncertainty is taking away some of the boom that they were hoping to get on the business investment side. You know, again, if these growth rates are going to be sustainable, it's going to have to show up in business investment. And I'd say the soft number there has got to be a little disappointing.